So, hello everyone. Hope everything is going well. So, our topic today will be about avoiding common mistakes and maximizing profit runs. As we can see, this month topics are more about the behavior of trading and how to behave when trading and how to trade well. So, this webinar aims to help participants to know the common mistakes, to avoid losses, and become a successful trader. Trading forex can be a rewarding and exciting challenge, but it can also be discouraging if you are not careful. So you have to always be careful and make sure that your trades are placed in the right way. Whether you're a beginner trader or an experienced, avoiding these common forex trading mistakes can help you keep you on the right track. So let's move on to the points, around 6 points that we're gonna cover. If we we can pretend that these are by book, so we have to abide by them, and then we can keep on the track. So we have 6 common forex trading mistakes. First, not doing your homework. 2, risking more than you can afford. 3, trading without a safety net. 4, overreacting. 5, trading from scratch. And 6, and lastly, it's trading with emotions. So first point, not doing your homework. So currency pairs are closely linked to national economies and are affected by many factors. They are also traded 24/5, so from Monday to Friday, 24 hours, unless there is any holiday, meaning there's usually something going on that will move the market. So during the whole week, there's the movements, unless there's some news that might make the market move faster. So before entering a trade, make sure you do your homework. What's your homework? So not only you should be aware of upcoming events that could affect your trade, but you also need to forecast which way these events could swing the market. So you have to look on the long term if this news, for example, or this event that's coming out, for example, the Federal Reserve when they are willing to increase the rates, interest rate. So we look, for example, for the next month, what's going to happen? What are the, for example, the federal people talking about the next rate increase. So you have to pay attention to what your technical indicators are telling you and how they compare to your fundamental analysis. So you always have to have fundamental analysis. We've discussed exactly how do we generate fundamental analysis. If you weren't attending in the session, you can get back to our previous on our website and you can check exactly what's the difference between technical, fundamental, and some more on other analysis. So number 2, risking more than you can afford. So you have to always make sure you don't just I want to go all in. No, I manage my risks, so I never go beyond what I can. So one common mistake new traders make is misunderstanding how leverage works. Familiarize yourself with margin and leverage to help avoid accidentally putting more capital at risk than you had planned. So first of all, as we all know, or if we don't know, also we can go back to previous sessions, we can know exactly what does leverage mean. Leverage is something that the broker provides the client or the trader in order to have a bigger capital, in order to have more liquidity to buy and sell in the market. Margin is how much I'm using from this account, and you can get more details and examples in the previous sessions. So many traders find it helpful to set a maximum percentage of their capital that they are willing to risk at one time, usually 1% to 3%. So I'm using 1 to 3% from my capital. For example, if you have $50,000 of equity and are willing to risk 2% as a maximum, you would not tie up more than $1,000 at one time. It's important that you stick to that maximum once you set it. So you have to don't be greedy, just keep this percentage and work on it while moving. So number 3, trading without a safety net. You cannot watch the forex market around the clock. Stop and limit orders help you get in and out of the market at predetermined levels. So basically you have to keep stop level, and you have to keep stop loss take profit. These are the limit orders. Like I know when I'm gonna enter, when I'm gonna close this, or when I'm gonna stop my loss. And then this not only allows the trading platform to execute trades when you are not available, but it also makes you think through the end of your trade and set exit strategies before you're actually in the trade and your emotions get the better of you. Keep in mind that placing contingent orders may not necessarily limit your risk losses. Number 4, don't overreact. Overreacting. A loss never feels good. It can make you emotional and irritational, tempting you to make knee-jerk reaction trades that are outside your trading plan. So whenever you have any loss, I hope not, but whenever you risk or you're into a loss, just manage your emotions and know what to do. So no trader makes a great trade every time, except that loss are part of the reality of trading, and stick to your plan. In the long run, your trading plan should compensate for that loss. If not, review your plan and adjust. So you have to go back and make sure that your plan in mind, or what you have on scratch, or what you have that you're moving on should be right. So number 5, trading from scratch. Using your hard-earned capital to test a new trading plan is almost as risky as trading without a plan at all. So you have always to have a plan to you in order to trade. So before you start trading using real funds, open a practice account and use virtual funds to try out trading plans to get a feel of the trading platform you're using. So always you want to try something, you want to try strategy, you want to try a new method, you want to see how market's going to react on news, anything, use a demo account. Don't use your real account. Your real money is for isn't for practice, it's for applying your skills, applying your mistakes. Although you will not be affected by your emotions the same way you will be when trading your own money. There's also a chance to see how you react to trades not going your way and learn from your mistakes without any risk. Emotions is the key. Finally, number 6, trading with emotion. Forex trading can cause emotion to run high, with currency prices are on the move of 24 hours a day. Keeping stress, fear, greed, and everything else in check is essential to trading successfully. Planning in advance and using different order types can help prevent you from making emotion-fueled trades. There is a reason why many experienced traders describe trading as repetitive. They don't abandon their rules. They approach the market with an unemotional mechanical method, session after session, day after day. They treat winning and losing days some while concentrating on the long-term goals. Trade within your means and your ability to develop almost trust in yourself and your system before contemplating raising stakes. Thank you for joining our session. Next session will be a longer one with more detailed how to enter the market at, especially now we are getting through more about the issues in America, what's happening in the Middle East, what's happening around everything, and how gold is moving down, and what's the reason, and when gold might go up. So hopefully next week we will be having a better overview on everything. Scan our barcode to follow us on our social media platform, and see you next week, my fellow friends. Thank you so much.